I don't know if this is, can everybody hear me? I generally don't have a problem. Thanks, Carl. First of all, go Army, beat Navy. Start off with that, but thank you for being here, everyone. As Carl said, I'm with Orca Capital. We're a boutique investment bank here in Portland, and investment banking, it's a very nebulous term. My wife probably still doesn't really know what I do. But really, we work with business owners to help them when they're looking to sell their business. And we'll put together, whether it's, in the preparation for that, through the actual transaction and advising on that, identifying buyers, negotiating with buyers, kind of soup to nuts. And so we're one piece of a team if a business is looking to sell. And so here I'm talking about kind of some of the things to think about when preparing your business for sale that will help kind of maximize the value of the business. I mean, first and foremost, you have to have a plan. If you don't know where you want to go, it doesn't matter which path you take. And so we're big believers in sitting with our clients or potential clients and coming up with that plan. It's always best to kind of start with the end in mind, because there's really only 4 kind of outcomes primarily that your business can pursue. You can sell to a strategic buyer, so another business that's in the industry. You could sell to a private equity firm, so that's a financial buyer. There's certainly, as Carl talked about, a lot of capital out there looking to be put to work, so very active. You could sell to a family member, certainly, and again, that's a path often pursued. Or you could even sell to the employees. But independent of what that outcome is going to be or the path that you choose, there's planning that you can put into place that will help facilitate the transaction and help facilitate it in a way that, again, that maximizes the value to you. Because for many business owners, right, this is the culmination of your adult's work, right? And you have one chance to do it. Most of the clients with whom we work, they've never done it before. They're not going to do it again, and so they get one chance, and you want to do it correctly. So what are some of the things that affect the value of a private business? Well, first and foremost, there's macro factors in it. Unfortunately, many of these things, if not all of them, are beyond your control. There's certainly the strength and the trajectory of the broader economy. Is it growing? Is it contracting? Is it kind of steady? The cost and availability of capital. A lot of transactions, there's a significant piece that's funded with debt. And as interest rates go up, that debt becomes more expensive, therefore it puts pricing pressure on a price that a buyer can pay, because they have to look at the all-in cost of doing that. The regulatory environment, is it becoming more expensive or more difficult to operate in your industry? Industry-specific dynamics, whether, again, is it a growing industry, contracting? Is an active industry from an M&A perspective? Are there lots of buyers out there, lots of transactions going on? Who are those buyers, and what are their motivations? Are they looking for, to acquire technology, acquire growth, acquire market share? So all of those kind of have an impact on what, the value of the business. And again, this is the perspective that, a rising tide lifts all boats. And so that, again, in good environments, right, valuations naturally rise. In bad environments, independent of the company's performance, they can go down. Now, micro factors, these are certainly company specific. I think first and foremost is EBITDA. And EBITDA, for those who don't know, it's earnings before interest, taxes, depreciation, and amortization. And it's really the primary valuation metric that you use in valuing private businesses. So when you hear talk of multiples, the equation has 2 components, the level of EBITDA and then the multiple, right? And so if EBITDA stays the same, multiple is going up, overall value increases. Revenue trends, are you expanding? Are they declining? Or are you staying relatively flat? Profit margins, in particular, how they relate to others in the industry, and specifically gross profit. Gross profit oftentimes is used as a proxy for determining the value add that you bring to your client. So if you have higher than normal gross profit margins, the implication is that you're able to charge more and therefore bringing more value add to your client. Customer and industry concentration. Do you have too much revenue with too few customers? Again, that that can lead to increased risk, because certainly the loss of any one significant customer has a tremendous impact on the overall value of the business. The management team, is the management team in place? Are they performing? As an owner of the business, what do you want to do post-transaction? If really the whole business revolves around you, you want to sell your business and walk away, well, that's a big part of the value proposition that goes out the door, and certainly buyers are not receptive to that. And then, what are your key competitive advantages? What is your unique value proposition? How protected is that? Is it, you have a widget that nobody else does? Do you have intellectual property that, protects what you do? And again, we work very closely with clients to really identify what that is and make sure that when we go out to market, we're conveying that to potential buyers so that they come to the realization that, hey, if I want, X, Y, or Z, this is the business that I need to buy in order to get it. So what does that all mean? Valuation, certainly there's a big piece of science to it, but there's a lot of art to it. And again, these are kind of on the left-hand column, kind of the factors that we talked about, EBITDA. The bigger your business is, the more valuable it's going to be, the higher multiple you're going to get for it. And so you typically see breakpoints, less than 2 million and over 5 million. You'll have, a lesser multiple for less than 2, and certainly a premium multiple for greater than 5. We talked about revenue trends. Are they variable, flat, growing? Certainly, it's better. You want certainty. And I think, stepping back, what I think I wanted to say here is, as you look at this chart, it really just put a risk assessment lens on. And anything that is perceived to increase the risk of the business will have a negative impact. Anything that, again, you can say that, you defray that risk or mitigate that risk will help increase the value. Gross margins, are you generating more dollars or more profit per dollar revenue than your competitors? There's certainly value in that. We talked about customer concentration. Ideally, no single customer is more than 20%. Certainly, there's ways to mitigate that. You can look at, is it contract-based? Has the customer been with you for 20 years? But in an ideal situation, again, no one customer more than 20%. Top 5, not more than 50%. Is the industry growing? Is it mature? Is it declining? How protected are you? What are the barriers to entry? The management team. And this is one of the things that kind of takes the most time to plan ahead for, right? Because if your team isn't in place and performing, you need to go find and identify that team, bring them in, and then they need to demonstrate a track record of performing within the business before, ideally, you go to market to potential buyers. And then growth strategies. Are you just relying on existing customers? Have you identified growth opportunities, or are you executing on growth opportunities? Again, all of those play a factor into valuation. And they're not equally weighted, depending on the industry, depending on the company, certain ones will be, more valuable than others. I'll tell you, nobody goes down the right column. I haven't had a client in 25 years that's all down the right column. It typically looks like a bingo card. But really, it's identifying kind of these key areas. And if you have a 3 to 5 year horizon, then the ability to focus and maybe move a little bit to the right on this table where it makes sense or where it's available can have a significant impact on the business. With that, I will hand it over to Chris.
Thanks, Randy. See if you get this right. Accounting considerations, which actually tie into what Randy was talking about, because how in the world can you know what it does if you don't know what your numbers are? Kind of talk about 4 different things: getting financial procedures in place, using data to improve your bottom line, the ability to react quickly when a deal comes along, and then understanding what the desired outcome is. Because ultimately, when you go to sit down and do a deal, there are a million ways of structuring something. But if you know what the end goal is, you can be pretty flexible in making that arrangement. One of the things I frequently see in my client base is the inability to get financial information together very quickly. I have a lot of clients who went into business to be geologists, restaurant owners, construction company owners. They did not go into business to be accountants, and yet that role has been thrust upon them. And they don't necessarily do it very well. Some of them do it better than others. Some of them just believe that all they need to do is get enough stuff together so that I can get a tax return filed by September so that they're in compliance with the IRS and nothing else really matters. The problem with that approach, and you can do it, I've worked with business owners who keep their financial information in their head and they actually do very well. Most folks who have worked in a business for a while have their pulse on that business. They don't necessarily need to look at the numbers themselves, but the gentleman in the construction industry who thinks that the financials that we produce for the tax returns are basically smoke and mirrors, he's not right, but he knows what his cash flow is. He knows what contracts are coming in and what's doing well and what's not. Doesn't ever look at the bottom line until we do the tax return, and then he just wants to know what kind of check he has to write. I worked with a gentleman who owned fast food franchises for years. He only ever looked at the P&L because he could tell from experience going down the P&L what ratios were right and what was wrong and where something was going out of whack. But the problem with that approach is it's really hard to scoop that knowledge out of your head and put it in somebody else's. So you end up with a business that can only do what the owner can manage in their head. And that's hard to translate, it's hard to pass on. So one of the key things is having procedures in place to produce financial statements fairly quickly after a period end, generally within 10 days if you can, after a month end, so that you can use that data to build a stronger company. You can use that data for your management team, which Randy pointed out is pretty important, to learn the business and to be able to manage from that. Once you have that, if you're actually looking to structure a deal, it's worth taking a little time to do a self-assessment. It doesn't play well with a potential buyer if you can't get them December's financial statements by June of the following year. It just looks like you don't know what you're doing. You need to be able to provide accurate financial information, and I do mean accurate, reasonably accurate. It doesn't have to be perfect, but it doesn't feel good to be called as a witness to talk about one of your client's financial statements when they're now in a breach of contract situation and people are complaining that the information that they gave the buyer is wrong. I've been there. It wasn't pretty. It ended well, but it wasn't pretty. Are your legal documents easily accessible? Your leases, your insurance policies, these are all things that a buyer is likely to want to know about, likely to want to look at and make sure your ducks are in a row. If you're an S corporation, do you have that original S election? If you've changed accountants a couple of times, you may not. And that is something that a buyer, particularly a buyer looking to buy stock, is going to want to see. They want to make sure they're not buying a tax liability that goes back 30 years that they're not aware of, and making sure that they've got all the proper signatures on that S election. I've seen that hold a deal up for a few days. Are you in regulatory compliance? Can you show it? One of the things I run across frequently is, do you know where you're doing business? I mean, that sounds like a ridiculous proposition. Yes, of course I know where I'm doing business. If you're a construction company, it's pretty easy. You've got a shovel in the dirt. It's pretty easy to know if you're in Oregon or Washington. If you're a service company, it's not that easy to know where you're doing business anymore. Most states have gone to market-based sourcing. So sitting here in Oregon, I'm doing business in Washington. I'm also doing business in Colorado. And have I crossed a threshold that says that I now have a filing requirement? And if I have, am I in compliance with that? That is a big deal, particularly in the service industry. Are your payroll taxes in line? Are you paying folks as independent contractors rather than employees? Is that going to come back to bite a buyer? Sales tax. It's possible to be required to report for sales tax in jurisdictions where you don't have any income tax reporting. With the Wayfair case just a few years ago, you no longer have to be on the ground in a state to have a requirement to file payroll taxes there. That's another. And then of course local taxes, which we're all seeing expanding frequently. One of the first things to know when you're trying to sell, something that Randy alluded to, what do you want the outcome to be? There are a lot of different ways of structuring a deal. Some are better for the buyer, some are better for the seller. Sometimes this is a negotiation. And if you know what your bottom line you really want is, you can be flexible. The sales price can be adjusted to make sure that you get what you want, but maybe the buyer gets the structure that they want. You need to understand the tax impact, but minimizing tax is not the goal. I've often had people say, I want you to minimize my tax. Well, that's fine, I can do that. An income tax scenario, I can do that perfectly legally. I will raise my bill so that your profit is zero, you will pay no tax, it's illegal. I will pay taxes on that, and I will smile the entire time. I cannot get anyone to take me up on that. Because you really know minimizing tax isn't the goal. It's maximizing wealth. And there's different ways of structuring things. So you need to understand the effect of the structure, but be willing to be flexible. Work with a potential buyer so that you both get a result that is something you can live with. When you're dealing with the tax impact, you need to understand it. There are different ways of selling. A stock versus an asset sale for a corporation has very, very, very different tax impacts. With a stock sale, you're typically dealing with capital gains that's taxable to the state of residency of the owner, lower tax rates, fewer jurisdictions you might have to be involved in. It's pretty straightforward. An asset sale, you're looking at the underlying basis of the assets in the company. You need to understand how that sales price is going to be allocated. You must agree with the buyer how that sales price is going to be allocated amongst various assets, different classes of assets. You have implications for ordinary income. You know, if you're a C corporation, there's double taxation that you need to be concerned about. If you're an S corporation, you need to understand the flow-through implications of what states that you're going to be filing your personal income taxes in, showing what gain. So knowing, you know, where you're going to have to file and at what rates. The sourcing rules vary from state to state, so you may find yourself paying tax in multiple states on the same income. You may find yourself paying tax in states on less than 100% of your income because of how the various taxing rules are structured. It's very important to understand that before you sign the deal, because if you don't, surprises in this industry are not fun. I don't care which way the surprise is, it's not fun. But particularly if you're writing larger checks than you think. It's pretty important to get just a model of the tax impact of the sale. And that modeling idea is good because, as I said, a stock versus asset sale can have very different implications, but there is a point at which they are the same, where the sales price, you know, goes up for an asset sale and reach the same position. There are reasons buyers don't want to buy stock. They don't want to buy your liability. But if you can get to the same place selling them assets, they aren't incurring the additional liability and you can have the same outcome. You have to understand if you're selling a stock in a corporation or you're selling units in a partnership, these are not the same thing at all. With a partnership, you have a look-through. It's much more like selling assets, even if you're selling units in a partnership. We had a very unfortunate case where one of our clients was doing a stock sale. Sounded great, absolutely fantastic. They signed the document and then finally showed it to us. Unfortunately, embedded within that document was an election they'd agreed to make that agreed to treat the stock sale as an asset sale. Very different tax result than what they were expecting. That did not end well. And it was a surprise to all of us. So as I say, surprises in this industry are bad. You always want to know what's going to happen before you get into it. And with that, I'll turn it over to Layla because, of course, once you you have your deal, it's important to know how you're going to keep it or pass it on.
Okay. Good morning. I'm here to talk about everybody's favorite subject, death and taxes and disability and how to plan for all of that. So the character here, this is kind of meant to be funny, and it is. As near as we can tell, the only thing keeping you alive is the realization that your son would inherit the business. Funny but true, and it's a very real scenario and one that I deal with very often. This is meant to be a joke, but again, this happens all the time. And if you don't have an estate plan in place, then the state of Oregon has a plan for you. And those are the default rules. And if you haven't updated your will since your last divorce, the state of Oregon has a plan for you. And they will decide what happens at your death or incapacity. And so some of the key questions to ask are, if something happens to you, who's stepping in immediately to run your business? Is that person capable of running your business? Do they have the legal authority to run your business? And then where is it going? And if it's going to your kids, do your kids want that business? And are they capable of managing it? Or are you better off selling it ahead of time? And then do your documents allow for all of these things, right? Because your estate plan can say whatever it wants, but if your buy-sell isn't consistent with your estate plan, the buy-sell is going to control. And so having continuity within your business documents and your estate planning documents is really critical. So 30% of family businesses make it to generation 2. 5 to 10 make it to generation 3. You should reread that stat. And planning for your business is one thing, but it has to be in conjunction with your financial goals, your personal goals, your values, your estate plan. Everything has to align. And it can be devastating, right? To imagine working your entire life to build a successful business only to have it destroyed at your incapacity or death because you couldn't take the time to get some planning done. So, do you know what your estate plan says? Do you remember? Is it that 1984 will still in your drawer that you haven't pulled out since then? And your kids were 2 years old and now they're in their 30s and you have grandbabies, or your ex-spouse is still named in those documents. Your 1984 will is not going to cut it. You need to start thinking about what happens next and really have the family fights now. So a lot of people don't want to do their estate planning because it's too real, right? Mortality is difficult to think of. But waiting until something happens and then expecting things to work out is not going to do you any favors either. And so I'm a big fan of having the family fight while everybody is alive. Your kids don't have to agree with your plan, but they should know what it is. And you should talk about it and be willing to share it so that you can have those arguments and have them in writing and document them and make sure that, despite not being in agreement, everybody knows what the plan is. The second piece here are the tax reasons for updating your plan. So this is everybody's favorite part. Under the federal law, which is in flux right now, as everybody I'm sure has heard, each individual can pass $11.7 million during life and at death tax-free. If you're married and you have decent estate planning, you can elect for portability and pass $23.4 million during life or at death tax-free. So I say during life or at death because the feds keep a tab on you during your lifetime. And so everybody, or most people have heard you can give $15,000 per person per year without filing a gift tax return. If you want to gift in excess of that, that's just fine. You have to file a gift tax return, say, hey, I gifted $200,000, and so now you can only pass $11.5 million at death. And so when I say the feds are keeping a tab, that's literally what it is. And so you're not going to pay a gift tax, right, until you've completely wiped out that $11.7 million exclusion. Oregon has separated itself from the federal regime, and Oregon looks at everything you own, even if you don't actually live in Oregon, if you own property in Oregon, real property, life insurance, retirement accounts, the gold bars buried in the backyard, everything you can imagine. And if all of that adds up to $1 million or more, you have a taxable estate. Just because you are married does not mean that you get to pass $2 million tax-free at death without some estate planning, okay? So in order to take advantage of each spouse's exemption, you have to have some planning in place and effectively split the bucket, one bucket while you're married, split the bucket at the first spouse's death, and have 2 shares. Surviving spouse still has access to the deceased spouse's assets, typically, they don't have to. And just doing that alone saves $100,000 in estate taxes off the top. So big numbers, right? And a lot of people don't hit those federal numbers, but certainly in Oregon, if you start thinking about your bank accounts, your life insurance, your home, all of those things, it's not hard to get to $1 million. I don't know if anybody's tried to buy a house lately, right? But there's nothing under $500,000. So something to keep in mind when you're looking at planning for death or incapacity is that Oregon doesn't care about gifts. And so while the feds are keeping a tab when you gift in excess of $15K, Oregon is not. And so we do deathbed giving all the time, right? I get a call at 10:30 at night, mom's passing away, she's got $1.4 million. That's taxable, right? We're gonna have to pay some taxes, sure. Let's look at what cash we have. Whether we have capital gains tax considerations, we're certainly not signing the deed to the home over to the kids. But in a lot of cases, we've been able to gift everything above that Oregon taxable amount out on the deathbed, get it out of mom's estate so we're not paying any Oregon estate tax. And sometimes it doesn't work for capital gains tax reasons, but it can if you have a relationship with your attorney. They know your assets and have some idea of what your plan is, and so your kids then have authority to complete this gifting. At that point, if you've got somebody you have a relationship with, you can effectively get this done. We are all in a scramble right now to do a ton of gifting because we are expecting that federal exclusion to change pretty drastically. If it is not replaced, it will revert back to what it was pre-Tax Cuts and Jobs Act, which will put it at about 6.2 million. And so there is federal legislation that says if you gift $23.4 million away and tomorrow we change that exclusion to $4 million, we can't claw it back. So we can't then say you gave more than what you could have given at death today, so now you have to pay us taxes. They cannot claw it back. And so with all of Biden's new legislation, we are doing a ton of gifting out of fear for some folks that this will be changing very soon. So, other things to think about. Have you moved from California or Washington? We are not a community property state in Oregon. Your documents are not going to do you any favors if they are not redone to maintain your community property status or assets. Your documents in Nevada, basically every state surrounding Oregon is not going to cut it because nobody is accounting for the state tax. Those states follow the federal regime. So the tax planning that I'm talking about with these old docs that are coming from California are not going to accomplish what you need them to in order to maximize your estate tax benefits. Capital gains is something always to consider. And then the GST tax. And so generation skipping transfer tax. If you have a federally taxable estate and you want to skip your kids, maybe you don't like your kids, maybe you like your grandkids, and so you're like, you don't need the money, or I just don't really like you, I'm going to leave everything to the grandkids. Sure, you can do that, but the feds feel as though, okay, well, if you've given it to your kids, they would have eventually died and we would have gotten to tax them too. So since you're skipping them, we're just gonna double that tax, right? And there are ways to plan around that to reduce or negate the GST tax, but it doesn't happen magically. And again, it's probably not in your 1984 will because the tax laws didn't exist at that time, right? So, and then, you know, if you don't have all this planning done, and even if you do, where's the liquidity coming from to pay that estate tax? Do you have enough cash, or does something have to be sold? And what is being sold? Fire sales are not fun when it's to pay a tax bill. So, again, create a plan that expresses your goals and your intent and make those clear with your family. Get everything in writing. Do not expect your wishes to be honored by your family because you told them on Christmas morning what you wanted to have happen with the family business. It will not happen. And then protect your legacy, right? You've built this business, so why leave things to chance? Saving a couple $1,000s now will not save you money later. The lawyers will always win. We will always get paid. And it is always more expensive to fix your documents or fix your estate or try to than it is to have it done correctly. Get your stuff done, put it in writing, and button it up, and then take a look at it every couple of years and make sure it still does what you need it to do and reflects your goals and actual intentions. And with that, I'm done.
All right, we're gonna have over here have a little bit of time for some Q&A, and you're welcome to just throw out. Lately, you have confirmed to me I've done a grave error. I have 4 kids, and not one of them are planning to be an estate tax attorney right now, and I am.
I'll talk about it.
You're talking about it. I was just about to say this is guaranteed money, death and taxes, and paid. So thank you for saying to talk them out of it. With that, just start out with crowd. Any specific questions that you have to our 3 speakers?
Question on the topic of stock versus asset sale. Are there common ways to adjust the price down for a stock sale in lieu of, like, say, to counter off some of the liabilities that would be included, specifically in a sale where most of the value is intangible value?
Let me see if you're wondering if going with a stock sale, is there a way of reducing it? My general approach on that is frankly to model the difference between what the tax would be on an asset sale versus a stock sale. You have to make some general assumptions, but you can see at what point the two of them become basically parity to the seller, that you're going to end up with the same net amount. Ultimately, it's all a negotiation with the buyer. And typically the buyer wants to buy assets because they really don't want to buy. It's not so much the liabilities you know about, it's the ones they don't know about. It's the lawsuit that's waiting out there because you offended an employee 2 years ago and you didn't even realize you offended them. So, I don't know that there's a typical way, but my approach is usually just to kind of model the two until I can see where the price point is.
I was gonna say, we advise our clients to look at a transaction on an after-tax basis, because depending on the entity, the tax impact from an asset deal versus a stock deal can be pretty significant. Sometimes, it's parity. So, again, always, look at a transaction, and you need to work with your CPA to figure out that, because it's not a simple calculation. And then when we understand that, then we're armed with that. And so depending on the transaction dynamic, oftentimes we'll try to negotiate, if it's an asset deal, fine, but you're gonna have to pay, 1.2 times that price so that our after-tax proceeds are at parity. But I mean, again, to Chris's point, we like stock sales because you're selling the business, it's easier, it's cleaner, all the liabilities go with the business. Certainly buyers don't like that. And really, one thing about, putting together the team and then running a process, if you're not, again, passing it along to employees or your kids, is creating kind of competitive dynamic for that so you can push on some of these things. It's really hard to negotiate with one party, right? But if you have at least two, ideally three or more, right, you can use the competing interests to drive a better value. Now, that's not to say we don't give the impression of having competing interests, even though maybe we're only dealing with one. But yeah, I think it's really important to look at an after-tax perspective, because that's ultimately what you end up with.
Thank you.
In my experience, larger buyers tend to be more willing to buy stock because they're more sophisticated. Frankly, they have a much more robust due diligence. So if you're dealing with a large corporate structure, that's where I've seen stock deals as opposed to asset sales. Smaller deals, I've solely seen asset sales.
Thanks.
Yeah, so one of my questions as specifically about the valuation today. When we look at a company and its valuation, how are we taking into account the impact of the pandemic, positively or negatively? We've all seen companies that this disruption has actually become an opportunity for them, and they've had unprecedented growth. We've also had companies that this paralyzed them, and they've suffered huge losses. And so here we come on the back end of this, and we're going to do our assessment and our evaluation. How are we taking into account this, maybe it's an artificial bump or an artificial, situation?
It's a great question, and it's certainly something we've been working through for the last, 18 months, 2 years. And I will highlight, both positive and negative. Buyers look at it, it's symmetrical, right? So buyers, when we had a number of transactions that we were in market with, pandemic hit, business kind of turned off overnight. They've been put on hold, right? And as they start to come out of that pandemic, we're starting to see more and more activity, because now we can show, okay, this was the impact of the pandemic, we've come through, and this is what our normal kind of state is. And we'll go back and try to quantify and add back kind of these one-time kind of expenses and occurrences that were associated with the pandemic to do, present a more normalized picture. Similarly, we sold a company a couple of months ago that had a nice little bump from the pandemic, and buyers aren't, buyers are savvy, right? And they're like, okay, well, that's great. You just made, $5 million in EBITDA selling hand sanitizer. How sustainable is that? And so they'll dig in, and as an advisor, we're digging in to figure out, okay, here's the performance, but what's sustainable? Because that's the only thing a buyer is going to pay for. And again, what's sustainable is a matter of opinion in many cases, and a matter of negotiation. So it's both positive and negative, but what you need to be able to do is tell a story on a go-forward basis. When we're back to normal, whatever that may look like, this is what the performance of the business looks like.
Thank you.
Good questions, by the way. Other questions?
At what stage or timing would you recommend a company do an evaluation? Is it prior to going out when you decide, okay, I think if it's all I want to sell, I think of at that point, or is it when somebody gets to you and knocks on your door and says, I'm interested?
Well, we like to meet businesses, several years in advance, because again, to the extent we can move some of those columns to the right, then bringing in other members of the team or other resources to help a company do that, certainly, one, it makes the business more valuable. Two, it makes the selling of the business a little bit more easier. When we come in and we're introduced to clients, we'll look at the market, we'll look at the industry, look at the company's performance, and come up with what our estimate of value would be. And it's typically a range, because we want to ensure that if we're hired to take a company to market, it's a 6, 8, 9 month process, a year. We want to make sure that as we get, bids for the business and they're kind of in line with what we had relayed, that our clients, we need to be aligned on that. And oftentimes, we'll get introduced to a business and we'll, learn a little bit more about the business. And if you have some significant growth events, if you, if your EBITDA is going to get above a certain level, I'll say kind of 2 to 3 million of EBITDA. Above that, your buyer universe expands significantly because there's a lot of private equity firms that's kind of the minimum that they're looking at. So it's kind of a holistic view, and I think, working, and we work, just to get to know clients over time, and ultimately, if we're needed, great. If not, we've helped somebody. But it's really kind of taken into fact a number of different considerations to kind of find the ideal time to do it. Nonetheless, we've had many situations where I get a call and say, hey, we had a buyer at the door, they come, they made this offer, can you help? Right? And there's only so much you can do at that point in time. So from our perspective, it's always best to be prepared, even though you may have a 5-year horizon, because that knock or the phone call may come in and you want to be best prepared as you can.
All right, thank you.
The tax planning also changes.
Yeah, right,
And
yeah,
the opportunities
absolutely.
to save on taxes and net a little more
Yeah.
can change pretty significantly. And while I work long hours, I don't want to work around the clock because you didn't plan well.
Like we
And
do
so
that
you
with
have,
me right now.
and it's a lot cheaper, right?
As I
If-
say,
if
that's
when-
way more
When
expensive.
you've got more time, it's
Yeah.
cheaper because you can delegate it to lower cost people and kind of oversee the project versus a, fire sale opportunity that knocks on the door. It's all hands on deck, and the bill will reflect that. And you don't have as many opportunities for creative planning, where really truly you're able to net more your abilities to reinvest in different things and defer taxes for many years or even death, right? It makes a big difference.
Good, appreciate it.
Any other questions? Question you didn't want to
I was
ask?
curious.
Go ahead.
How often do you,
Oh, go ahead. Go
how
ahead, Chris.
often do you have a valuation that comes out way out of line with what your prospective client is thinking?
When we do our value, we go through the process and we look at it from a buyer's perspective. This is how the buyer is going to look at your business, and you look at where public companies are trading, you look where other private deals have occurred, and in those situations, it's typically we think I guess the more thing is, this is what I need for my business, right? And that's what they're basing the value of their business on, where, not to be glib, but a buyer doesn't care what you need for your business, right? And so ideally they match. Oftentimes when they don't, it's like, well, let's talk again next year. And you have one chance to do it. And our approach to it, again, we put forth what we think is a reasonable valuation for the business, but our goal is to certainly exceed that, right? We want to under-promise and over-deliver, and when we don't, there's a bit of disappointment on our side, but oftentimes we do. But it's all about putting together a process, and it's all about preparation.
Yeah, I'll just ask one more question. I just want to, here you are in the local market. You're working here in the Pacific Northwest primarily. Last week, the New York Times published an article that small and medium-sized business owners have pushed up their desire to sell. So if the plan was 3 to 5 years, they're saying, we're exhausted, and we want to sell in the next 12 months instead of in 5 years. Are you seeing that trend in our local market as well?
Yes.
One of my partners has a client who is basically selling at almost nothing because he's just done.
Yeah.
He's had more than he can take, and he's not willing to put in the additional hours that he has to any longer. He can't get employees. He can't sustain the business without that, and he's willing to walk away for almost nothing.
I was gonna say, there's certainly a level of fatigue out there. I mean, 2008 doesn't seem like that long ago, right? And I think that pushed people's planning out at least 5 years, right? That's like, oh my gosh, I need my business now to recover, because you really need some look back to help inform the future. And then of course everything that's happened over the last 18 months to 2 years, combined with raw materials and supply chains combined with labor issues, I haven't seen a company that hasn't been impacted in some way, certainly some more than the other, but there is a level of fatigue. And, when we meet with businesses, it's really understanding kind of the motivations, seeing where the business could go, and maybe bringing in additional resources to help that owner so that, take some things off their plate, because you have one chance. And, I say it over and over, but you have one chance to sell a business that it's been your life for 20, 25, 30 years, and you certainly want to be very thoughtful about doing that.
I mean, I hate to say it, but one of the areas that we're seeing people leave are CPA firms. The last 2 years with the law changes and everything else, and kind of the nonstop, I've been talking to professionals who say I retired 1 year too late. And they're leaving in droves.
Same thing with insurance agencies. And
Yeah.
it's a common thing. I will say this though, you should be asking what's next. I think we all met a number of people that finally get that number and they finally think they're going to be happy by selling their business, and they're depressed the rest of their lives. They don't have purpose anymore. So people should be planning about what's next. And that's a lot of what Nick helps out with people, because that part, it's so sad. I read a terrible story of somebody who sold their business for $100 million and they blew out their brains the next week. I hate to be so glib about that, and all of a sudden I'm talking to a tax attorney, talking away. But that is the sad part of what happens, is because literally they don't have a purpose anymore in their life. And so thinking about what's next and what they're going to do, and no matter what it is, because honestly, people with a golfer or a fisherman, they don't honestly want to do that 360 days a year. Well, at least not here in Oregon. But it's not the common thing. And so thinking about those plans and having a plan around that, I think is super, super important, because when you have all the money, it's like literally what's next, and what's going to drive happiness for you, and how you're going to make a difference in the world. So anyways, I think that's another consideration beyond this that's radically important, because sometimes you'll find a person will only get 1 to 2 or 3x of their salary from the sale. So I was like, what was that for, right? Were you just trying to get rid of your headaches, your salary, or your purpose? Did you if you get rid of some of the stuff you're thinking about, are you actually happy going and doing this continuously? I think there's a difference on being in the deathbed and not wanting to sell your child, but those things are all to consider for sure.
We give it to charity a lot of times because we don't like our kids,
Yeah.
Or the kids don't need it. They have enough and they've been successful, and that's wonderful, right? And so you get some good touchy-feelies, and there are other options.
That's right.